Okay, let's go ahead and talk about partnership liquidation and the topic of what's referred to as a schedule of safe payments. When a partnership is to be liquidated, the assets are converted to cash, the liabilities are paid off, and then the partners are paid their remaining capital balances. Now, the liquidation process may take a great deal of time. If the partnership wants to maximize the value they receive for their assets, they don't simply want to have a fire sale right away and sell everything for the best price they can get that day. They want to market it properly to appropriate customers, and it might take a long time to convert all of the assets to cash. In the meantime, the partners, they're going to want cash payments so they can pay their personal bills, so they can invest in other enterprises. So they're constantly going to be clamoring for cash payments. So at any point in time during the liquidation process, we'll be faced with a question of, can we give the partners any cash, and if so, who can get how much? Now let's assume we have the following trial balance for the ABC partnership. We have $40,000 in cash and $460,000 in other non-cash assets for total assets of $500,000. We have liabilities of $20,000. A has a capital balance of $150,000. B has a capital balance of $80,000, and C has a capital balance of $250,000. And let's go ahead and assume that A, B, and C share profits and losses in a 3:1:6 ratio. So at this point, can any of the partners be given any cash, and if so, who can get how much? Now, at this point, we have $40,000 in cash and only $20,000 in liabilities. Creditors have first claim on the firm's assets, so of the $40,000 in cash, $20,000 has to be held back to satisfy the creditors. That means we have $20,000 of cash that can be safely paid out to the partners. This is where the term safe payment comes from. The question is, which of our three partners should receive it? Now, C has by far the largest capital balance, so should C receive the money. At the other extreme, B has the smallest capital balance, so should he be at the end of the line when it comes time to pay out capital balances? What we're going to do is work through a sort of worst case scenario. First, we're going to assume that all of the non-cash assets are worthless. Right now we've got $460,000 in other assets, and that could be inventory, property, plant, and equipment, intangibles, what have you. And again, we're going to assume those things are completely worthless, and there will be a $460,000 loss on those assets. That loss will be divided among the partners in their profit and loss sharing ratio. After allocating that sizable loss, it's entirely possible that one or more partners will have a deficit after absorbing their share of that loss. Continuing with the idea of sort of a worst case scenario, we'll assume that any partners with a deficit will be assumed to be personally insolvent. Now ideally, the partners with a deficit would write a check to the partnership making good on their deficit balance, but again, we're going to assume that they will be unable or unwilling to make that payment, and so their deficit will have to be absorbed by the remaining partners. We'll continue this worst case scenario sort of what if process, and at the end of this, the safe cash should equal the remaining capital balance of the partners and will be paid out in that manner. So let's go ahead and go through this example. So we have our initial starting point. Here's our trial balance, cash and other assets totaling $500,000, liabilities and capital totaling $500,000. We first assume that all of the non-cash assets are completely worthless. So the non-cash assets or other assets are reduced by $460,000. That $460,000 loss is allocated directly to the partners' capital accounts. A absorbs 30% or $138,000, B absorbs 10% or $46,000, while C absorbs the lion's share or 60% of $276,000. As a result, we have the following balances. Again, we have cash of $40,000, other assets are assumed now to be zero. We've still got liabilities of $20,000. A's capital balance is down to $12,000, B's is down to $34,000, and C has been more than wiped out and faces a $26,000 deficit balance. So we're going to assume that C is personally insolvent, and so we allocate C's deficit to A and B. And again, A and B share profits and losses in a 3-to-1 ratio. So A is going to absorb 3/4 or 75% of C's deficit, while B will absorb 1/4 or 25% of C's deficit. After doing that, we bring our balances forward. Again, we've got $40,000 in cash, 0 other assets. We've still got $20,000 in liabilities. A now has a deficit. After allocating C's deficit, A has now been wiped out and has a deficit of $7,500, while B still has a positive capital balance of $27,500. Continuing with the worst case scenario assumption, we assume that A is personally insolvent, so A's deficit will be absorbed by the sole remaining partner, B. So basically A's $7,500 deficit is transferred to B. B's capital balance is reduced to $20,000. So our final balances, we've got $40,000 in cash, of which $20,000 has to be paid out to the creditors. The other $20,000, the $20,000 of safe payments, can be paid out to partner B. So we see that although B had the smallest initial capital balance at only $80,000, since B bore the smallest share of any losses, B was in the safest position in terms of being subject to having his or her capital balance wiped out. Since B bore only 10% of any losses, it would take a huge loss to wipe out B's capital balance. In fact, looking at B's capital balance, B bears 10% of any losses. It would take an $800,000 loss to wipe out B's capital balance. There isn't $800,000 in other assets, so B is never going to be completely wiped out. B will always be the last one standing. Okay, let's go ahead and continue with this. Let's assume that $20,000 payment is made to B, so we take $20,000 out of the cash account and pay that out to partner B, reducing B's capital balance by $20,000. So we've got the following balances after that safe payment is made: $20,000 in cash, $460,000 in other assets, $20,000 in liabilities, and the partner's capital balances of $150,000, $60,000, and $250,000 respectively. Now let's go ahead and assume that we sell $200,000 of the non-cash assets for $150,000. Again, cash is going to go up by $150,000, the other assets go down by $200,000, and we've got a $50,000 loss. And again, that loss will be allocated directly to the owner's capital accounts, 30% or $15,000 to A, 10% or $5,000 to B, and 60% or $30,000 to C. So we have the following balances. Cash is now back up to $170,000 because of that big infusion. Other assets down to $260,000. Liabilities $20,000. A, B, and C with the capital balances as indicated. Again, we again have some safe cash to distribute. We have $170,000 in cash. We've only got $20,000 in liabilities, so we've got $150,000 of cash above and beyond what we need to pay our liabilities, and the partners will all be banging on the treasurer's door saying, I need a check to cover my mortgage or for whatever other reason. So, we again have to go through the schedule of safe payments process. First, we assume a total loss on the non-cash assets, so the entire $260,000 in non-cash assets is written off as a total loss. The loss allocated 30% to A, 10% to B, and 60% to C. Now, in addition to holding back $20,000 to pay off our liabilities, there may be some concern that there would be some unforeseen expenses or some unrecorded liabilities. It wouldn't do to pay out all the cash that's available to the partners only to be presented with a $20,000 bill from the lawyer or the accountant or the property tax authority. And so we might wish to hold back, again, this is a worst case scenario sort of exercise. We might say, look, we want to hold back $10,000 for unforeseen expenses. So if there's a $10,000 expense, that's going to cut into our cash balance, and that expense will be divided among the three partners in their profit sharing ratio or loss sharing ratio. So we're going to go ahead and reduce this. Again, this is a pro forma analysis. We're going to go ahead and reduce the cash by $10,000. 30% of that is going to be borne by A, 10% by B, and 60% by C. After doing that, our final balances would be cash, $160,000, $20,000 in liabilities, and the partner's capital balances, $54,000, $28,000, and $58,000 respectively. Now, at every stage through this process, our trial balance has balanced all the way through. So at this point, we've got $160,000 in cash, we have $20,000 in liabilities, and the combined capital balances of the three partners are $140,000. That means that at this point, we could take that $160,000, pay $20,000 to pay off our liabilities, pay $54,000 to A, pay $28,000 to B, and pay $58,000 to C. Now again, we don't have $160,000, we have $170,000, but we're setting aside $10,000 as though it doesn't exist, or as though it's already been spoken for, and saying we have $160,000 that we can pass out to various claimants, $20,000 claimed by our creditors, the remaining $140,000 claimed by our partners. As a final step, let's go ahead and go through the payment of those safe payments and see what our final balances are. So our balances are as indicated: cash $170,000, other assets $260,000, liabilities $20,000, and the partner's capital balances as indicated: $135,000, $55,000, and $220,000. Again, the ending balances on the previous slide were the pro forma or worst case or what if balances. These are the actual balances which we're working with. We make these safe payments to the partners as we calculated just a moment ago. Again, we had $140,000 of excess cash to pay out, and we determined that in a worst case scenario, A would get $54,000, B would get $28,000, and C would get $58,000. So we go ahead and make those payments to the partners, and what we're left with then is we've got $30,000 in cash, and again, that cash is $20,000 to cover our liabilities, plus $10,000 more that we set aside to cover any unforeseen expenses or unrecorded liabilities. We've still got $260,000 in other assets, we still have liabilities of $20,000, and we have the partner's capital balances as indicated. And again, the nice thing about this is that at every stage through this process, the equality of our trial balance is being maintained. On the left-hand side, we have the partnership's resources, cash and other assets. On the right-hand side, we have the claims on those resources, liabilities, plus the partner's capital balances.